Hello, everybody, and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. Before we dive in, standard disclaimer: nothing here is investment advice. Do your own due diligence. And this episode is brought to you by MoneyMetals.com, the most trusted online bullion dealer and depository in the United States. Use Money Metals for purchasing, selling, or storing physical gold and silver. Hit the link in the description below to learn more and use coupon code JESSEDAY to get a $10 discount on your first purchase. Today's guest is an economist, former Wall Street insider, and best-selling author. Her latest book, Permanent Distortion: How Financial Markets Abandoned the Real Economy Forever, is available now. Dr. Nomi Prins, it's an honor to have you on.
Thank you so much, Jesse.
Well, as a new guest on the show, we always start with the origin story. So, when did you first discover investing? How did that lead you to becoming a Wall Street insider and ultimately becoming an author who sheds light on the dark corners of the global economy?
These are all excellent questions. Basically, I was a math wonk from a very early age. My dad was a major programmer, statistician, world famous multivariate data analysis, author of many books. And so the idea of numbers and data and patterns and trends was pretty much a part of our sort of family culture from when I was very early single digits. I learned to code when I was 9. So, I had a propensity for that. Graduated high school at 16. I graduated college at 19, during which time that year, I got a job at IBM. And while there as a programmer, I decided I would like to move to New York. And I found myself a headhunter, or actually I heard about what they were, didn't know at the time. And from the difference between a Friday to a Monday, I effectively got an interview at Chase, interviewed at Chase, and got a job offer at Chase before my 20th birthday. So I never really thought about investing per se, but I was definitely interested in numbers and in the technologies that were developing at the time and coding at that time. And Wall Street, this was in the late 80s, Wall Street was very much interested in growing on all of those fronts and in my skills. And so I started at Chase. And over the years, I worked at Chase in options and in futures, traveled a lot, moved to Lehman Brothers, also on sort of very initial workings of options and futures and sort of global investments at that point for central banks and other major financial institutions. From where I moved to Bear Stearns in London, where I created and grew their international analytics department. And I spent 7 years there. Working with all sorts of investor asset classes, security classes throughout the 90s. And then moved to Goldman Sachs as a managing director at Goldman Sachs, where I then ran 2 groups. One was related to derivatives and credit, and one was related to sort of larger, more complex structured investments for institutional clients. Around that time, though, I was becoming disillusioned with the industry, with the business. It was also around the time of 9/11, so there was a lot of just thoughts in my mind about life being too short, wanting to speak and tell the truth. At the time when I left Goldman, which was 2002, it's a long time ago now, there were no inside Wall Street, we call them now, or I'm called now, whistleblower, talking about the inner mechanics of Wall Street and how it operates and how it largely still operates with respect to other investment classes, retail investors, and so forth. And so over the last couple of decades, I've written 7 books. I've spoken around the world. I work with a speaker as an advisory, run a few investment newsletters and so forth, as well as continue to look at trends globally from the financial side to the commodity side and every place in between.
Fascinating. And I want to pull on a thread there when it comes to the derivatives market. You have a ton of experience there. I believe it was Warren Buffett who called derivatives financial weapons of mass destruction. They were in many ways responsible for at least partially for the 2008 financial crisis. How does the derivatives market stand today? Do you think overall it's a net negative for the global economy?
Well, derivatives in general don't really benefit the global economy. They're largely investment or sometimes hedging of investments or protecting investments vehicles, but there's also a large pool of traders and trading that goes about with derivatives. When I left Wall Street, it was at the beginning of something called credit derivatives, or basically things that were ultimately attached to the subprime crisis. Not to get into a lot of that detail, I wrote a couple books on that, but basically even before that 2008 crisis, I warned in my first book, Other People's Money, The Corporate Mugging of America, which also looked at energy and communications and other sorts of, at the time, scandals that were happening and how Wall Street was involved, and specifically how derivatives were involved at the core of some of those scandals. And one of the things that derivatives do and still do, and there's a lot higher volume in the world now, almost a quadrillion dollars worth, lots and lots of zeros, worth of outstanding derivatives out there, or at least the value of those derivatives could encompass that amount of money. And as a result, there's a lot of leverage in all sorts of markets that isn't related to how an economy is moving or even how interest rates are moving, but amplifying those effects in terms of how speculators are moving around them. And so they are dangerous if they go wrong. I mean, and the fact is that we've seen that in the subprime crisis. We've seen that with a lot of corporate loans and corporate defaults that have been attached to derivatives as well, which don't get as much attention. And even in the energy markets and oil markets and so forth, derivatives movements can amplify the ups or downs of geopolitical or other related, supply demand related activities in those areas. And so they're useful for banks. They have use for investors if you are careful. But as a general economic benefit, um, that use is really overshadowed by some of the other leverage and other things that the derivatives include in them.
I want to touch on a tweet you made recently where you said banks have now loaded up on 1.2 trillion in risky hot deposits, marking an 86% bump from last year. As the FDIC chair has already warned, such moves can offer liquidity risk and are something to watch over on Wall Street, like deja vu. Could you explain what you mean by risky hot deposits? And is this something that's likely to lead to further bank failures or other systemic issues in your view?
Well, first of all, tweets, we have to sort of encompass a lot of things in very few words. So it's good to be able to unpack some of that. But basically, there's two things going on in the banking industry right now, well, among other things. One is that as Treasury yields have risen and therefore bonds have dropped in value because of the Fed raising rates from last March through now, and still kind of at the end of that process, but still raising rates potentially a bit in November and possibly into next year. But the point being that as this has all happened, the value of treasuries that banks hold on their books has fallen. And typically, banks hold treasury bonds on their books for what's called liquidity purposes, meaning that if their depositors decide to take money out of the banks, then they can actually at least sell some treasury bonds to raise cash in order to do whatever other activities they may be doing. But when this is happening quickly, as we've seen earlier this year with Silicon Valley Bank, with Signature Bank, with First Republic, we've seen, and also in regional banks, this is still going on, depositors taking their money out very quickly of some of these banks, not least because they're not getting a lot of interest on their deposits relative to where else they could put that money. And as a result, these banks, while at the same time their treasury values are falling, don't have the money to compensate for the money going out with the money that they have or that they can sell. So this is a problem. So when I talk about hot money, that's basically money that's moving quickly. And they don't have the wherewithal to be able to accommodate a lot of those potential outflows with the bonds that they're holding. This is potentially an issue for hundreds still of regional banks in the country. In fact, the Federal Reserve put out a report earlier this year before those particular failures where they said that there's 732 banks in the country that are at risk of failure because of this specific process that has also caused other banks to fail already. Recently, just last month, Moody's and Fitch put out downgrade announcements and watches on a number of fairly decent sized regional banks noting basically the same thing. And as recently as the middle of October, we have seen that banks are writing down losses that they've been holding on anything that's attached to an interest rate. So consumer loans, mortgage loans, auto loans, because people have not been able to necessarily pay the interest, which has gone higher and higher as the Fed has raised rates on these loans. And so these loans start to deteriorate. Banks are holding them. Banks are holding trillions of dollars worth of loans, but as they start to write some of these down and take the losses, in other words, publicly announce them, that creates more uncertainty in the stability of the banking sector as a whole. So we have a lot of issues that are currently being faced by the banking sector. Again, we've seen failures here and there. A lot of things to watch for failure, as the Fed indicated in their 732 banks to watch report, as well as some of the downgrades. So the banking sector itself is really facing a lot of existing and potential accumulating problems right now.
Do you think we're in a higher for longer rate environment? And is inflation going to continue to be an issue? Because the Fed's tool to try to quell inflation by raising interest rates in many ways does not seem to be working, at least as they hoped. We're seeing energy prices rise, which obviously energy is the input into all economic activity. So that will then spread inflation to a variety of prices. People's cost of living has certainly gone up. Um, are we in for a higher for longer environment? What are your thoughts on inflation, and what does this mean for the economy and markets?
Yeah, great questions. And the thing about inflation that everybody actually feels, even though it's not the headline of what Federal Reserve Chairman Jerome Powell might talk about when he talks about the Fed's ability to change it, is that we are still seeing prices rise. Now, what inflation means and what inflation measures with respect to the Fed is how quickly those prices are rising. So we have had spikes after COVID because of supply and demand issues and so forth. We had a significant increase in the rate of inflation. In other words, how quickly and by how much prices are rising at any given moment. To some extent, that pace or that amount has come down a bit since the Fed has started to raise interest rates. However, this does not mean prices have come down, and this does not mean that prices aren't still going up. They're just doing so at a slightly slower pace. And as you mentioned, and thank you for mentioning that, because I think this is something that the Fed does not understand at all, but that energy prices in particular impact every single part of the economy. And even the statistics, the CPI, the PPI, the what's called core CPI, where you take out supposedly food and fuel prices to see a sort of a less inflation oriented number, still includes energy, because you cannot strip fuel prices from anything. You and I talking right now requires energy. One of the pieces of information that comes into some of these statistics, for example, is hospitals, ambulances, medical treatments. All of these are not able to operate without energy. So when fuel prices go up, everything costs more. So you cannot strip them away. So what the Fed has been promising for the last year and a half now is that it can somehow impact things it cannot impact. It cannot impact the price of oil. Certainly not in the world in which we actually live in. The price of oil is impacted by supply and demand, by transportation, by geopolitical issues, from Russia invading the Ukraine to what's going on now between Israel and Hamas in Israel and the Gaza Strip, to what's happening at OPEC, to what is happening with the BRICS countries who are trading amongst each other, oil and related products. And none of these, absolutely none of these, can be impacted by the Fed. The only thing that the Fed could potentially impact with respect to these prices is if it was able to basically shut economies, sort of on the level of what we saw during COVID, which it cannot do either. So I think it's incidental that as the Fed has been raising rates, there have been periods where fuel costs have abated, and now we are seeing them rise again, because ultimately it has nothing to do with the Fed. and it's not gonna. And so there's a danger with what the Fed does and how it's perceived by the media and by people and by themselves in terms of perpetuating that they have the ability to change any of these data points or variables or costs that they truly cannot. So that's an issue. Now, what they can impact are things that have to do with interest rates and payments, to an extent, how many mortgages people take out, whether people can afford to take those mortgages out, whether because of that they can afford to buy houses. So we have seen some movement in house prices or specific items that are very, very directly related to the cost of money. But when you put them all together into one big inflation pot, the Fed really just doesn't have control over that. And that's an issue. So higher for longer. I believe the Fed's going to stop raising interest rates after potentially this November or so the next meeting for a while and step back and kind of watch what happens. And I believe they basically should have been doing this because, again, I think it's incidental what inflation's been doing, particularly in the last few 6 months, as the Fed's kind of gone to a up 25 basis points stop, up 25 basis points stop in terms of their policy, which seems kind of really neutral anyway on rates. But what we might see next year is significant slowing down of economies in general, or bank failures popping in because of where high rates are and so forth. And then we could see a situation where the Fed actually starts to decrease rates by a bit, or starts to print more money to accommodate if we have a big bank loss or sort of a big other type of an event where they need to go back and sort of do more QE. So when we say higher for longer, I see it more as kind of where we are, but potentially actually coming down more towards the end of next year, if any of these things happen before that.
Bit of a big picture question for you here, and that is, do we have free markets at this point in time, or are we living in a centrally planned system with free market characteristics or something else? What's your view there?
I think it really depends on which markets we're talking about. If we look at the stock market, for example, yes, of course, there are regulations in terms of the transparency of publicly traded companies. And then there's regulations in terms of which sector those companies are in and how they need to adhere to whatever rules there are, whether it's in the energy or whether it's in the communications field or the medical field or whatever. But from a broader standpoint, which is, I think, what you're getting at, if the Fed, for example, or other central banks are controlling the value of money, whether it's raising rates, keeping them stable, cutting rates, printing money, moving towards potentially alternative currencies, if you're the BRICS bloc and looking at that, then you have all these outside factors that aren't about simply buyers and sellers in a market that are impacting when things move up, when things move down, how much volatility there is in the market, and so forth. And to that extent, they're less free because they're dependent on these outside non-market forces, really, particularly central banks, and then how they feed money into the system or take it out, which kind of takes away from that freedom of just having them sort of back off and letting markets do what they do, net of course keeping safety and transparency and those sorts of regulations around. So net of that, yeah, this is this external control of mass amounts of money is certainly a factor on the markets that make them less free.
Your new book, Permanent Distortion, covers how a political power shift is bringing in a new world order, why trade wars have only just begun, and why we're in for more civil and social unrest as a result. From what's been happening over the last few years, I can say it certainly seems like you're spot on. Could you break down the main trends you're seeing that caused you to draw that conclusion, and where do you think things go from here?
Yeah, so I mean, I wrote that book during COVID. Um, and so at that particular time, I was looking at information going into the COVID period and then how things were unfolding during sort of the beginning years of the COVID period, during which, of course, we had seen significant unrest around the world in 2019, going into 2020. That was the year, I believe, was Economist and a number of other major publications quantified as having the most uprisings and civil unrest that we had seen up to that year. And of course, now that we're seeing much more this year, I mean, that was basically what I was looking at in terms of a trend. And in the years of COVID, or when things were shut down, there was less of that because people were just simply less out. But the trend was there, and so what we've seen more so is that accelerate, with Russia and Ukraine, with what's happening in the Middle East, between Israel and Hamas and what's going on in the Gaza Strip, and all of that has been obviously indicative of major unrest in the world. And in the book, I talk about other areas of potential unrest, Taiwan and China, and different areas as being potentially explosive. And from the standpoint of alternative world orders, I also look at it from a currency perspective, right? And how countries are trading with each other and the trend that's going on there. So, for example, just recently, we've seen that Russia and Saudi Arabia, this is before the what's going on now with Israel and Hamas, but just in general, we're cutting supply. That's a way to also elevate oil prices and demand, of course. We saw just after that supply cuts at OPEC or OPEC plus, including Russia or other oil exporters, had decided to continue along the line of those supply cuts or supply reductions. And we've also seen more and more, including in the last BRICS summit in August, that a lot of emerging market nations, BRICS nations, and sort of non-G7 countries, or sort of non-old world order countries, are moving towards more trade with each other in their own currencies. So, for example, in the Chinese REN, there is certainly a movement of having more trade, for example, between China and Russia, be denominated in those two currencies, particularly in the Chinese REN currency, and not in US dollars. So all of this is kind of happening, and there's a lot of studies that are going on by countries around the world. Indonesia was the latest, about de-dollarizing predominantly their trade. And every time that happens, every conversation amongst countries that used to trade just in dollars, or used to settle their trades just in dollars, and now are settling trades in local currencies or regional currencies, we do see a shift in, therefore, buying power and trading power towards those nations. And so we have been seeing that. When I was writing the book, we're continuing to see more and more of that. And as the BRICS nations, so Brazil, Russia, India, China, and South Africa, are expanding in January to include 6 other nations, 3 of whom are large oil-producing nations, including Saudi Arabia, we're going to see more and more of that trade take place outside of U.S. dollar, or outside of petrodollars for oil, and also other commodities. And so all of this is a shift. It's not like it's tomorrow that the dollar is going to go away. In fact, the dollar is going to remain the major currency for trade and the major central bank currency of exchange for our lifetimes. But its breadth, its power gets diminished and chipped away at every single time these outside trade agreements or these outside international blocks strengthen. That's just the math of it. And so these are all things that I talked about in Permanent Distortion that have just continued to evolve, with these details since that book came out, which was last year.
I have to then follow up on the BRICS, and you mentioned alternative currencies a few times. There was supposed to be potentially a gold-backed currency announced at the last BRICS summit. I believe it was the Russian embassy in Kenya tweeted out something about that, caused a lot of buzz online. But ultimately, nothing concrete was announced. Do you think they are in the process of developing some sort of gold or commodities-backed currency? And do you think that's a feasible undertaking for them to actually release a new currency for trade backed by gold or commodities?
I do. The question is how long that takes to develop and what it looks like. And that's not certain yet. And I don't think it'd be like 100% backed by gold or commodities, but it could be linked to some, say, combination of currencies and sort of their evaluation relative to gold. There's different ways it could work out, such that gold or other commodities are part of a currency without being 100% backed by, because we just don't actually have enough gold in the world to back all of trade. But linking those currencies to gold and to gold prices would be one way to do that. And I do think there's a lot of conversation going on about that. We had the president of Brazil, Lula, talk about potentially an alternative currency at the last BRICS summit. Again, with no specific details, but that could involve some sort of a hybrid, average of, let's say, large BRICS countries plus gold or plus commodities. So there's a lot of different ways of creating currency. It doesn't mean you or I would be necessarily buying or selling items even when we travel in that currency, but it means that from a standpoint of trade, which would be the first place where something like that could logistically and I think feasibly be adopted, because we're already seeing these sort of side trade agreements between regional nations and so forth. So the idea would be, let's adopt something we all agree on, or say the BRICS plus the next 6 countries or however it looks like could agree on. I do think that would be the first step. I do think that's in development. I do think there's a reason that a lot of these central banks in these nations have been stockpiling gold, and we have seen 156% increase last year over the year before in terms of the appreciation of the amount of gold that they're buying. This is all part of having the leverage. When I say leverage in that standpoint, I mean backing of gold to whatever type of alternative currency or form that might take. So yeah, I think it's being developed. I don't think it's going to supplant the dollar. I do think it's going to be some sort of an agreement between those countries, and potentially some sort of an averaging. It's going to start in trade. Maybe it goes from there into currencies that are associated with central bank reserves. But it's going to be a long, long while before anything like that would make its way into the public hands. But in general, every time there is a development in currencies, whether that's going from physical to paper to digital, there's always still movement in the commodities involved. And I think that's one of the reasons we're going to see more appreciation in gold, for example, because, well, not least because it's a good storage of value. And particularly we see in these times of a lot of global stress and tension, that it does hold value and appreciate in value during those moments. And with this extra demand from non-U.S. sort of powered countries or wannabe non-U.S. powered countries, we're going to see more of that.
I want to touch on central bank digital currencies here. Obviously, being the desired monetary system for the global elite, the IMF has spoken about potentially launching some sort of global CBDC system. How close are we to the launch of CBDCs? Does this actually present the threat that everybody's making it out to be online? Obviously, this is a lightning rod for hyperbole. People are saying that governments are going to make programmable currency that's going to control everything we do. I've heard some people say that this whole thing's destined to fail, pointing to Nigeria, where they tried to launch a central bank digital currency, and that did not seem to work at all. The public did not accept the adoption of it. So what are your thoughts on CBDCs here and the future of that type of currency?
Yeah, so I mean, first of all, the Nigerian adoption. We're talking about a small country whose sort of external economy relates to predominantly oil, which is controlled by effectively the petrodollar. So I mean, it's not going to. It's not really a prototype for, I think, where a CBDC could really go. It's just an initial basically try to show that countries are developing these things and they are looking at them seriously internally and so forth. Every single OECD country is looking at this. 134 countries that are looking at different aspects of developing a CBDC. It is on the Fed's website. They have been furnishing and funding white papers on central bank currencies for years. This is happening throughout the world. So we are going to a digital currency. It's really just a question of how and when. It's not like every single central bank is doing all of this analysis for the sheer hell of it. That's just not what's happening. So what do you need in order to actually have a CBDC or digital currency be utilized? Well, you need a system. If you don't have a system, you cannot transact. That's just the base reality of it. And so, for example, FedNow, the system, which is a payment system that the Federal Reserve is now using with major banks and major companies, is to me, a prototype of a system that will ultimately have a digitized currency attached to it, because that just is the evolution of needing the mechanism, and then so having the currency sort of work on the mechanism. And so what I think it will ultimately look like is a lot of countries will start from a central bank perspective with some sort of a digitized currency or reserve currency system, which will then feed into their banking system, which could look like FedNow or could look like some amalgamation of FedNow and other major country systems, but they can all talk to each other. I mean, that's ultimately the idea. I mean, right now there is electronic transfer all the time of central bank currencies from one central bank to another, to defend currencies, to do balance of payments, to do lots of different things. That's just what happens. So I think that will go through some logistical system like FedNow that will be global. Can that be programmed? Yeah, that is just the reality of the situation. For the same way that you need a system and a platform in order to have central bank or digital currency. The reality is these digital currencies do have the ability to encompass lots and lots of information in them because they are digital that your paper dollar simply does not cover. Yes, when you transact electronically from your bank to buy something, or you pay your credit card, or you use your credit card over your phone to buy something, all these are electronic transfers. And currently they're not in digital currencies. They have a trail. A digital currency will be able to have a much larger trail and to be programmed just by default. So what does that mean for us in terms of, sort of major fears, smaller fears, security issues, privacy issues? There's a lot that comes into play. Right now, people have the choice, to an extent, to use cash in some societies. Some don't. I was just in Sweden and Norway last month, and there's like no cash anywhere. Those are completely almost cashless societies for reasons, but they have a very technologically advanced society. Everybody has a bank account, everybody has a phone, but they are, and that's where the U.S. is going, and that's where the nations are going. So at that point, if everything is completely digital and there is no cash, then you don't really have control over what you choose to show and what you don't choose to show. And that does become a privacy issue, and it does enable governments and central banks to know ultimately 100% of what you're doing. That includes money. And to keep sort of mini databases on everyone, whether how that's acted upon is a separate conversation. But is the technological ability there? Yeah.
So, given everything that we've discussed today, all of the turmoil going on, the ballooning government debts, the fiat system seemingly under threat in many ways, civil unrest, wars breaking out across the world, how can the individuals listening potentially safeguard their wealth in times like these? You mentioned gold earlier. Do you think owning some amount of physical gold and maybe silver is smart? Is there anywhere else you look for wealth preservation right now?
Yeah, absolutely. I look at gold, I look at silver, I look at copper. These are all precious metals or industrial metals, with copper that are intrinsic to wealth preservation, to inflation preservation, to growth, and to safety. And they also have use values. Um, Silver and copper, perhaps more so than gold, but they're also involved in our energy transitions, in our energy growth and energy demand usage. And so they have a lot of different elements to them, which are part of society, part of civilization, part of just our imprint in the world. And so for that reason, when we do have these volatile situations, and even if that comes to bear on prices moving up and down of any of these metals, I think over the long haul, you want to be owning them to preserve your wealth, and also the movement of energy processes, of products, of services, of everything else going forward. For the same reason, I look at other parts of the energy sector. I'm a big bull on energy in general because again, the Fed can't control it. And yes, it does come to bear with so many geopolitical factors, some of which we've talked about, probably more to come. But as a way to hedge your own personal inflation and be a part of any growth, owning commodities from or companies that are specific to oil, to natural gas, to uranium, and to nuclear energy, where we're moving as well to energy transition materials, whether it's lithium or zinc or cobalt. I think these are all part of a solid portfolio that not only can withstand a lot of volatility that comes in from all these other factors, but that is part and parcel with us growing as just civilization and requiring energy to power everything we do. And some of these other precious metals, which have a foothold also in on the energy side, but also have their own value from a currency and longevity and historical perspective. So to me, these are areas to be involved in. And then any technologies, particularly on the energy side, whether it's from an AI standpoint or from an efficiency standpoint, from a grid update standpoint, all of these things that are part of the infrastructure, physically and technologically, of energy, I think have also a lot of long-term upside value.
Well, Nomi, it's been an excellent conversation. I learned so much. It's been a joy speaking with you. Could you tell us a little bit more about your book, Permanent Distortion, where people can find that, and anywhere else you'd like to direct people online?
Sure. Yeah. So Permanent Distortion, I mean, it's available on independent bookstore sites as well as Amazon and everything else. I continue to read it, honestly, for facts on where we have just been and where we're going, actually. So I think it's very relevant to what we're seeing in the world today and a lot of what we just discussed. And on my website, which is www.nomiprins.com, I do have a sort of keep in touch with me tab under the contact form, where if I'm traveling or seeing trends or looking at things I'm going to be exploring for books to come, I just sort of give a free sort of shout out to whoever's on that list. It's completely private. Don't share it with anyone at all. Completely free, but just a way to sort of for me to communicate. And so I'd urge anyone to sort of fill out your email. Again, stays with me and me alone, to keep in touch with the latest in what I'm thinking relative to how my older books or just written books are connecting to what I'm looking at now and what I'm looking at for the future.
Great. Well, I'll put a link to your website in the description below for anybody who wants to check that out. Thank you once again for joining us today, Nomi, and sharing all your knowledge with the audience.
Thank you very much.
And thank you for joining us today. As a reminder, this episode is sponsored by moneymetals.com. Use coupon code JesseDay to get $10 off your first purchase. Link is in the description below, and I'll see you guys on the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.